Alright guys, so let's talk about Japan today and how their economy is under tremendous pressure. Of all the G7 allies, Japan is perhaps facing the worst crisis of them all. They have a monstrous debt problem, over 260% of GDP. Yes, that's the number. And when that bubble pops, it's game over. Now, secondly, they are facing very harsh talks with the US in a tariff war. Trump's auto tariffs threaten to tear apart Japan's biggest industry, the auto sector, apart. Now, Toyota, for example, is facing a horrific billion-dollar profit hit in just 2 months. The company, like many other Japanese brands, were just too reliant on the US market, and now things are starting to unravel. And if you're Japan, you're just focused on the short term fix. Nothing you can do about your debt problem today. But if you don't fix the issue with the US now, then your economy could really collapse. Unlike China, Japan just doesn't have much time to wait it out. They must take action as soon as possible. Japan's revised GDP is out and is not looking good. Q1 GDP contracted by 0.2%. That number has been revised and it is now confirmed. And that's January to March. We haven't even factored in Trump's reciprocal tariff shock in April. Q2 should be negative once again, which will confirm a recession for Japan's economy. So you can see Japan's dilemma here. Like most export based economies, the default way out of a recession is to sell more stuff to the world. Even the Bank of Japan is uncertain about hiking rates because industries are already on the edge. The last thing they need is higher borrowing costs. And that's why Japan is scrambling to get a deal even before the G7 summit. They simply cannot wait. They don't have the economic leverage that China, the EU, or even Canada has. And this is where things get tricky. Japan also needs to keep their exports affordable to the world. They just can't depend on the US market anymore. But Bessent's Treasury Department just gave Japan a stern warning. The Treasury is asking Japan to hike rates. BOJ tightening should continue. Growth is too low and inflation in Japan is too high. Japan has to normalize the yen's weakness against the dollar. And here's the most important part that betrays the agenda for much needed structural rebalancing of bilateral trade. And once again, the US doesn't really care about Japan's economy. The real plan is for Japan to strengthen their currency, to crush their own export sector, and that in turn will help the US be more export competitive. But is Japan really willing to do that? And how much further must the yen strengthen for Washington to be happy? Now, according to Deutsche Bank, if the US really wants to wipe out the trade deficit with the world, it would have to weaken their currency by a whopping 40%, and that is simply insane. The dollar has already dropped by 10%. Does that mean another 15, 20, or even 30% drop is on the cards? Because if that's the case, we can all kiss goodbye to the value of US assets and the entire financial system. We are heading back to Weimar Germany style. But does Bessent have a point? Japan does indeed have an inflation problem, no denying it. It's much higher than the entire G7 bloc, even higher than the US. And because of that, it's hammering Japanese consumption down. People in Japan are just not spending enough money. Now, the US says strengthening Japan's currency will fight inflation, and that makes sense. A stronger yen means cheaper imports, but it's not that simple. The yen started to strengthen from July 2024, but Japan's household spending was still collapsing. Even in March, despite the base effect, spending contracted by 0.1%. Sure, the yen today is stronger, so imports will cost less. Japan can import stuff at a cheaper rate, but that alone doesn't determine spending will suddenly rebound higher. And just like any other country, consumer behavior is reflective of the economy in general. And now that Japan is one foot in the coffin, about to enter a recession, does it make people more or less likely to spend money? Now, fighting inflation is paramount, but there's a reason why the BOJ isn't hiking rates just yet. The sequence of events is really critical here. First, the tariffs will have to drop so Japan's export economy can recover. Only then can you try to raise rates to strengthen the yen to fight inflation. Now, Norinchukin Bank agrees and points out what Bessent just doesn't understand here. Consumer spending is unlikely to help drive the economy when the impact of tariffs is expected to hit external demand. There's also no link between higher wages and inflation, at least for Japan. Their only way out now, the path with the least collateral damage, is for tariff removal. But will the US do it? Even Lutnick has admitted that the US might not be seeking just reciprocal trade. There's more to it than that.
But I want to get back to reciprocity. You just said you don't believe in you don't accept reciprocity as a goal. What are you negotiating in these trade deals?
But why would we open our bank account and their bank account when
Why are
ours is
you
10 times
negotiating
bigger?
trade deals? You're trying to get other countries to lower their tariffs and trade barriers in return for us lowering ours. Are you or are you not seeking reciprocity in these trade deals?
We are absolutely seeking reciprocity with respect to things that can be reciprocal.
But you just said
But when they're
that
importing
if a
from
country-
China and sending
You
it to us,
just
they're
said that
not.
if a country came to you and offered you the ultimate reciprocity, no tariffs, no trade barriers, in return for us doing the same, you would reject that.
Of course, because they buy from China and send it to us. Don't you agree with
Suppose
me?
they said we won't buy from China.
Now we're talking.
So will Japan listen to US orders and contain China? Will the BOJ hike interest rates just to help the US export more to the world? Now I find this highly unlikely. In the latest negotiations with Japan, even the Dream Team couldn't agree amongst themselves. Lutnick, Bessent and Greer were all disagreeing with each other. That's how dysfunctional the American team is by itself. And according to reports, they even put the talks on hold at one point with Japan to quarrel amongst themselves. And it seems they were all competing for credit from Donald Trump, and this is just so bizarre, right? This is the exact same squad being sent to London for talks with China. Now, Japan needs to find a way to arm twist the US to drop the tariffs. They can't just wait for the US China talks to pan out. It could take days, weeks, or even months, who knows? Tokyo just doesn't have the time. Japanese lawmakers are thinking of using the expansion of the Trans Pacific Partnership as leverage, basically to remind the US that Japan might even start including China and Taiwan into the group. Now, will this work? No one knows. Trump is very mercurial and he's very different from his first term. If he's insistent on reshoring the steel and car industry, nothing Japan does can change that trajectory. But when it comes to currencies, I believe it will be a cold day in hell. Japan themselves can't afford to hike rates, not when their own bond market is in danger. Rates in Japan are already going through the roof. The Bank of Japan is being forced into a corner, and there's a big internal debate whether to slow the pace of bond buying reductions to just 200 billion yen per quarter. Since December 2024, the Bank of Japan has been selling off their bond holdings net on net. The fact that they are slowing down the reductions show there's still a need to support the bond market. Well, that's what happens when you do yield curve control, the endless buying of bonds for over a decade. Sooner or later, you'll get trapped, and whatever you do, something in the system will break. But speaking of bond markets breaking, the US is about to face a reckoning of its own, and that shouldn't be a surprise if you kept up with the Treasury auction, the Treasury action over the past few weeks. Investors around the world are extremely skeptical about holding US bonds. No one really trusts the US to get their fiscal house in order, and that's a fancy way of saying Washington is still spending money like drunken sailors. And no matter who Trump sends to sell the dream, it's just not working. Whether it's Lutnick, Bessent, or now Mike Johnson, anyone can see through the denial.
The one big
This is adding a lot to the national debt.
No, it's not. No, it's
I mean,
not.
it is.
No, it's not. The CBO is arguing that if we extend and make permanent existing tax cuts, that's going to add to the deficit. What we're doing in this bill is cutting $1.6 trillion of spending that is government spending that creates the deficits. We're going to reduce the deficit with it.
Debt's going to be higher at the end of this, even if this
Not with our
passes.
pro-growth policies.
As a bondholder or someone looking to buy US debt, you'd be horrified. There are no guardrails left when it comes to national spending. Everyone is singing the same tune. Trump has very strong control of the narrative, so we can expect the bill to pass with minimal modifications. So the bill is going to add anywhere upwards from $2.4 trillion to the national debt. Credible independent sources are all projecting that increase. According to the Tax Foundation, Trump is willing to trade $2.6 trillion in national debt increase for 0.8% boost to GDP. and this should also create nearly 1 million jobs. This is basically borrowing money from the future to fund economic growth today. Trump is hoping for the tax cuts to balance out the hit from the tariffs and to reshore industries. Now, on paper, can this work? Sure, it can, but it's predicated on two big assumptions and they must all come true. There must be a fairy tale ending with the fairy godmother smiling and waving her magic wand. Now, firstly, countries need to reshore industries to the US. But with business uncertainty through the roof, that part is going to be a mighty challenge. Secondly, bond yields cannot possibly go higher because it will crush the US economy and blow up the national debt even further. The debt market is about to face a crucial test. This is the big problem. Bessent will be selling $22 billion worth of ultra-long 30-year government bonds to global investors. It's part of the scheduled issuance, but still a serious barometer for investor confidence. Should the auction crash and burn, the message will be unambiguous. Global investors are done lending money to the US government. It will be a rebuke. It's a signal that US inflation will become a structural problem that gets worse while deficit spending will continue to go out of control. Now, the 30-year auction will be a direct referendum on US government spending. I mean, just think of this statement. I am willing to lend the US government money for 30 years at say 5% because I believe they will keep long-term real inflation below that. And do you know how ridiculous that sounds today? More importantly, we have to watch if foreign investor demand is still there or not, because if it isn't, then it's the beginning of a much deeper problem. In the previous debt auction, domestic buyers were the problem. They bought only 14% of the bonds versus the 6 months average of 17%. People were simply afraid of inflation. But if international buyers really start to shun US debt, it's a sign that the dollar itself is the problem. Foreign money would be betting that the dollar will continue to drop and stay down for the long term. And when it comes to long term bonds, the Federal Reserve has little to no influence. It's all about market dynamics, supply and demand at its most brutal. Now, my guess is that the auction will face serious issues. If Trump really wants to bring back US manufacturing, he will have to break a lot of eggs and flip over the entire trading order. The US current account deficit is still at an incredible level at minus 3.8% of GDP. To reverse that to zero will take a titanic effort. The main thrust will be Americans buying domestic products, so inflation will get structural. It will also involve buying less from the world, so dollars flowing to the global economy will dry up as well. Now exporters have less money to recycle back into American stocks and bonds, and I think you get the picture. If investors see this as an outcome, which is very possible, they will just dump their bonds now or simply refuse to buy new ones. And neither outcome will be good for Trump or the national debt. He wants to cut off the world, but ironically, he still needs global investors to buy in. But let me know what you think. Will Japan listen to US orders? Or will investors really give US debt a fighting chance? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.